Thank you. Morning, everyone. I'm Nick Carlisle. I'm the founder of Platinum Portfolio Builder. We have a stand literally just behind you. Now, I would normally speak on property investing for about an hour, so this is a fairly condensed presentation. But I would invite you to come and spend a little bit of time with us on the stand afterwards if you have some questions. So my 20 years in property, just a very quick, brief overview. I started investing in property back in 1993, not because I was some property guru or understood property, simply because my dad, who was a stereotypical Yorkshireman, he worked in a mine, in the mines, paid into a pension for about 40 years, and when he got to retirement, got about half of what he thought he should have and what the projections were. And I remember thinking, at the age of 19, that if he just bought one other house in his entire lifetime, that would have completely changed his retirement. And instead of him taking money out of his pocket on a monthly basis and putting it into a pension, that investment property could have put money into his pocket, and the capital growth from the property would have outperformed any pension. So this is what I bought, a very dull, boring, 3-bedroom terrace house, a Coronation Street style property. And for the next 5 years, I traded property. I bought and sold until I learnt the 2 golden rules when it comes to investment property. Rule 1 is never sell investment property, and Rule 2 is don't forget Rule 1. Because when you buy investment property and hold it for the long term, that's where you get the majority of the gains. I also trained as a quantity surveyor, a QS, managing larger scale projects like this. So this is in the centre of Sheffield. But alongside that, I was trading property, buying and selling property. We moved into larger refurbs, and for the last 15 years, pretty much everything that I've bought in the UK, I haven't sold, and that now forms the basis of my pension in the way that it didn't for my dad. We moved into doing some self-builds. I became a developer until the credit crunch happened, and then what happened, we went overseas, started buying overseas. That turned out to be a disaster, if I'm perfectly honest, because when the credit crunch happened, a lot of those countries, Czech Republic, Romania, Bulgaria, haven't yet even started to recover in the way that the UK has. And fundamentally in the UK, you can make significant gains if you take the medium to long-term view with UK property, because fundamentally we have a massive shortage of housing in the UK, and that is never, ever going to go away. I now go back full circle to where I started back in 1993, and in the next year we will buy between 300 and 500 properties for ourselves and our clients. Now, these are properties in the north of England, so for those of you that are from London, our average purchase price is about £60,000 with an average end value of 80 to 85,000, and I'll explain how it works. So please come and talk to us on the stand if you've got any questions, but essentially we build portfolios for clients who want to invest, but they don't have the time, the skill, or the inclination to do it themselves. And we literally take care of everything. So the client owns the properties, but we source the properties. We buy a lot of our stock from banks, receivers, stuff that is off the market, and we only buy stuff where we can get a genuine discount from what the property is worth in today's market. So we will find properties that are worth 100,000, and our maximum purchase price, inclusive of all costs, will be 75,000, and often it will be less than that. And these are independently verified by independent surveyors, and most people in this day and age can do their own research to a certain extent. We refurbish the properties. We have our own lettings and management, so you don't have to worry about tenants, toilets, and we manage the whole properties. We arrange finance, sort all the glue that holds the whole thing together, so that you can carry on doing whatever it is you do on a daily basis, knowing that in the background is this property portfolio that's taking care of itself. And ultimately, it's about giving you more freedom and choice. So that's what we do. We've got a team of 22 people. We're up in Yorkshire if you'd like to come and see us. It's about 2 hours train journey. And they installed electricity in Yorkshire a couple of years ago. So for those of you that are from London, you're kind of safe to go that far north. You don't need jobs or anything like that. I've got 4 rules. Normally I'd have about 10, but I'm really limited for time. So I'm going to share with you 4 golden rules if you're considering property investment. So rule number one, and this is so prevalent in property, and now that the UK market in terms of property is starting to move, we're starting to see lots more get-rich-quick schemes. People think that property is get-rich-quick. I can tell you from experience over the last 20 years of losing money in property, it can be extremely risky. If you want get-rich-quick, here's a scheme that I think will work. Okay, you might want to write this down. I saw this in a magazine. It said simply set up a premium rate phone line, and to find out how, just call this premium rate phone line. That's about the only get-rich-quick scheme I've ever seen. If you're going to gamble, don't do it in property. It's a lot more fun to go to Las Vegas and put 20 grand on red or black and enjoy the nightlife and all of that. Property isn't get-rich-quick, okay? You need to look for the medium to long term. And from where we are now, the property market cycle over the last 100 years or so has been an 18 to 20 year cycle. We're probably 2 or 3 years into the next 18 to 20 year cycle. I reckon the cycle's going to be quicker. I think it's going to be shorter. I think in sort of 12 to 15 years' time, we will look back after the next correction saying, why did we not learn from the correction of 2007, 2008? But you know what? When it happened in 2007, 2008, we looked back and said, why did we not learn from the correction of 1989, 1990? And when it happened then, we looked back and said, why did we not learn from the correction in 1975? We just don't, because fear and greed drives the market, and we're now into that correction. So recognizing the cycles, I'm going to whiz through this really quickly, but please come and talk to me. There are 4 things that need to align for the property market to start to move. Now, the first is a given in UK property market, and it's simple supply and demand. In the UK, we're a tiny island. We have net immigration, a growing population, and we're not making any more land. We've got some of the most restrictive planning laws in the world, and so there's a fundamental shortage of housing in the UK. Now, if you're ever bored one weekend and you want to read a 650-page report that the government commissioned on the UK housing, the Barker report from 2006, it's about 650 pages, but Barker basically said that we need to build 240,000 new homes a year for the next 10 years. For the last 5 years, we built less than 100,000 per annum. So supply and demand is the first thing that's a given. The next thing that needs to align is affordability, because even if there's demand for property, if people can't afford property, they won't buy. Now, as you look at the graph here, at the peak of the market, house prices were up to 5 times people's salary. Now, that's too unaffordable. Okay, so what the graph tracks is the affordability as measured on a quarterly basis by the Nationwide. Now, the reason we got this high was in 2000, banks started to overlend, and you didn't need a bank balance, you didn't need a job, you didn't need money in the bank, you didn't need pay slips. All you needed to get a mortgage was a pulse, and they would lend you money. And then they introduced self-certified mortgages, which allowed you to tell them what your income was, and they would believe you without any checks. And then they allowed you to borrow up to 7 times your income. So it drove prices upwards, and the affordability didn't matter. Since the credit crunch, the affordability has started to come more in line, and we're now starting to align with affordability. And outside of London, prices are becoming more affordable. So that's the second thing. You have demand and you have affordability. The third thing is finance, because if you have demand and you have affordability, but banks aren't lending, then people won't buy. They can't buy. Most people buy with a mortgage. Now, since the credit crunch, or since before the credit crunch, banks would lend to anyone. You could tell them what you were earning and they trusted you, and they were throwing money around like there was no tomorrow. When the credit crunch happened, no one could get a mortgage. Even professional property investors like myself were maxed out of the market for about 9 months, and in spite of 20 years of solid payments, couldn't get a mortgage. Since then, we've started to see new lenders coming back into the market, and some of the lenders on here, pretty much all of the lenders on here, we wouldn't have dealt with 2 years ago. There's a significant influx of new lending coming into the market. So that's the third thing. The fourth thing, which is probably the most important thing, so you have demand, you have affordability, you have finance, but the most important thing is confidence, because even with the first three, if the papers, if the press are telling us that the end of the world is nigh and Greece is going to implode and what's going to happen in Europe, people will hunker down and they won't make decisions. Now, here are some headlines from the FT from about the last 6 months. There was a sea change in the headlines with regards to UK property about 9 months ago, where most of the press, most of the papers were saying doom and gloom, the end of the world is nigh, and about 9 months ago we've started to see a little bit more confidence coming back into the market, and that's going to start to drive prices upwards. So those 4 things, demand, affordability, finance and confidence, are starting to align, which means that property prices are on the up, and this is happening outside of London. Manchester outperformed London on a headline numbers, and you have to look behind the headline numbers, but Manchester outperformed London in terms of average property price growth last year. Rule 3 is don't buy sexy and exciting. Now, this only applies to property. It doesn't apply to cars or holidays or shoes or anything like that. It only applies to property. Because what's the 2 most important words in property are dull and boring, okay? Because what you need to buy when it comes to property investments is dull and boring stuff. You need to buy 1 and 2 bedroom apartments, 2 and 3 bedroom houses that people are always going to want to live in, that are affordable to the masses, that give strong yields, give strong income, because dull and boring means safe, secure, solid, reliable. And that's what our investments are about. We're not about get rich quick. We're not about buy today and sell tomorrow. There's massive risk in that. This is about pension provision. This is about additional income streams. This is about providing a safe and solid investment platform that you can build from. The other 2 most important words are yield and discount. So we average in our property investments, we get an average of anything from about 8 or 9% gross yield. Now, in London, you'll be lucky to get 3 or 4%, and our average discount is about 28% on a portfolio of about £40 million worth of property. Okay, and those two words also mean safe, secure, solid, reliable. This is what this is about. This is not about get rich quick, as I've said before. So here's an example. This is a real live example. I can give you the postcode. You can check it out. In today's day and age, every single thing that I say, you can get online and you can check. So this is John and Tanwar. They're British expats. They live in Saudi Arabia. They wanted to invest in UK property, but they live in Saudi Arabia. So how are they going to do that? This is a block of 13 flats. Incidentally, when we buy property, we buy flats, but if we're selling them, we sell apartments, because you can buy flats cheaper than apartments. So this is a block of 13 flats. Surveyed value of 900,000. John and Tanwar bought it for 600,000. Independently verified, you can see the numbers. Now, the numbers on there look quite attractive. Now, John can't go out and buy Tanwar a new car or anything with that. But what he's done with those numbers is he's de-risked the investment, and that's what this is about. So he's built in enough equities that should his circumstances change and he needs to exit the investment, he can sell that. He might not make as much money if he needs to sell it quick, but he can sell it. There's enough headroom in there. But more importantly, the double-digit gross yield means that after he's paid his mortgage, after he's paid the insurance, after he's paid for tenants that don't pay, and all of that thing that happens in property, it's still putting money into his pocket on a monthly basis. And that's the key to those investments. It's about de-risking them from day one, but with a view on exiting in 5 to 10 years' time as we reach the peak of the market. The last rule is probably the most important. We see this all of the time, waiting for the perfect time. Now, in 1993, I bought 1 property. Okay, if I'd known then what I know now, I would have bought 300, 400, 500 properties. Anyone wish they could do that? Go back in time? We call it analysis paralysis. Now, it's important to do analysis, it's important to do diligence, but if you wait too long, we're into the next property market cycle, which traditionally has been 18 to 20 years. I think it's going to be shorter. Has anyone got a time machine? No? Well, the reason we're so wealthy from a property point of view is I've got a time machine and I keep it in my mum's shed, and every Tuesday afternoon I take a few portfolio builder clients and I go back to 1993 and I buy a load of properties. Anyone wish you could do that? You can't do that, but I really hope that 20 years from now, you don't look back on this day and think, God, I wish I'd listened to that slightly strange northern bloke that was telling us we should invest in property. Because 20 years from now, we will be looking back saying, why didn't we learn from the correction of 2007, 2009? But when the correction comes, prices will still be a lot higher than where they are today. And the only bad time to buy property is later. Thanks very much for listening. Our stand is there. I've completely run out of time. I'd love to talk to all of you more about property. Please come and visit us on the stand. My colleagues over there, and I look forward to speaking to some of you later. Thank you.